So you want to be ready to answer the questions while you're entertaining and at the kitchen table of what's going to happen with mortgage rates. All the headlines that everybody's going to be talking about, what do they really mean? And overall, what's happening in the housing market. So while you're out there getting your holiday shopping, food preparation, and homes cleaned, you'll be the first to know on this month's edition of Keeping Current Matters and the National Housing Market Update. All three of those, including what else many people will be asking, which is now a good time to buy or sell. Well, thanks for sticking around. And as always, we want to make sure to slow down and thank each and every one of you for an amazing year. All of our coaching clients, our clients all across the world, family and friends, what an amazing community. Thank you for all you do, and that of making sure that we keep you current. We know that there's a lot that matters as you start approaching a new year, and we want to be mindful of it and just say thank you. As always, by keeping you current, you know that we're here for questions, the expressed interest that you have. Always excited to answer those questions. So let's dive right in to the three topics we'll discuss today, which really is what is going on with those mortgage rates, what do the headlines really mean, and overall, what is happening in the housing market. And as you can see from this slide, what's happening with mortgage rates is exactly what this looks like. They're going up, down, they're going a little bit to the side. Are we going forward or backwards? I don't know. We just know that they flipped upside down from where we were at the beginning of the year. And in this segment, I'm going to share projections on where they will most likely be, but the main indicators that you can follow to help you also know where they will as well. As you can see, Lawrence Yun shared a return to a normal spread between the government borrowing rate and the home purchase borrowing rate will bring the 30-year mortgage rates down to around 6%. What this is really sharing is what many people hear when you see the headlines say the feds have raised the rate or the feds have lowered the rate to 0% once upon a time a couple years ago. That didn't mean that mortgage rates were 0%, but what we're saying is this spread can be easily followed, and what you can follow is that of the 10-year Treasury. As you can see, for almost the last 50 years, the 30-year mortgage rate has moved in unison with that of the 10-year Treasury. And overall, that average spread on average has been 1.7, but you can see that spread has changed quite a bit over the last couple years. So as we start diving into how close is this, well, at the end of the day, 2% could be a good gap for us to look at. What does the 10-year Treasury say? Add 2%, and there you go with a great prediction of what's happening with mortgage rates. What we do know, though, is that this year overall, you can see, not taking the last 50 years, but the 10-year Treasury in one singular year has done nothing but go up. And this is really the story of 2022. The results were based off inflation and mortgage rates when you look at those results of what happened in the real estate market. And as we can start looking at what are people predicting to see happen is why are mortgage rates not 5.5%? Because when you look at where that 10-year Treasury is now, you add that spread, they should be around 5.5. So as you can see, over the last 21 years from 2000 to 2021, taking that average spread, we were roughly around 5.28%. As we look at if we took that normal spread right now, we should be at 5.49. However, we're at 6.49 today. Remember, a little bit of that is because it's not directly related. We're just saying the correlation is very strong if you're looking for predictions. The 6.5 has to also do with the overall chair's desire to slow things down, which we'll cover in a couple slides. So as you can see, the housing market is expected to face continued uncertainty heading into 2023 as consumers, financial markets, and policymakers work through their respective challenges in today's economy. What they're really saying here is nobody needs to be educated, and the last thing you want is me to try to share too much information. They're just saying that while you, the consumers, are taking your time to make decisions, the financial markets, mean the ones giving this money to us, and you have to remember, most of them are predicting that you're going to refinance if you were to borrow money right now. And that is a high probability. So they're not going to retain a lot of what they're doing, which is also making some of the pricing not as favorable, which therefore slows down demand. And the policymakers, obviously, their decisions on what they're trying to do, not just with mortgage rates, but that of inflation and how to impact today's economy, all of that is what leads to uncertainty. However, during uncertain times, there are certainly some things that we can follow to get great predictions. And we're going to share those in mortgage rates in a second. But as you can see, Barry Abib, who, if I was a betting man, I would bet on Barry as a mortgage expert over the last several decades. He says, because we see a slowdown and we see the inflation comparisons start to become more and more favorable, you'll start to see that inflation number move lower, 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 and lower. And as a result, mortgage rates should move similarly on a downward trajectory, probably giving us around 5%, below 5% within the next 6 months. So I want to share this as a prediction of a very good prediction, meaning if they got to below 5% or 5%, you're most likely going to see a massive amount of people come back into the market due to the fact that inventory is still low, which will make it more challenging for those who right now it could have been a great time. Now, is Barry correct? Well, we're going to have to wait and see. There's a lot of things in the economy that he's expecting that would lead to this number, and we can't just trust the headlines or one person. You need to make these decisions based off of enough information for you to make a decision, and then overall working with a professional, gaining a decision to start taking steps to work towards. Doesn't necessarily mean to make a final decision. But as you start looking at don't trust the headlines, we usually say headlines do more to terrify than clarify without the proper context. I just want to give you 2 examples so that way you're prepared around the kitchen tables, and more importantly, while you're entertaining. You can see here that Diana Olick, homeowners have lost $1.5 trillion in equity since May as home prices drop. Well, she failed to mention that there's still $10.3 trillion of equity, tappable equity. And as you look at that, that's the highest number since 2005 outside, you're right, the last 2 years. So you're going to see a lot of headlines that the context is clickbait, not to clarify, because right now you can see from this slide our tappable equity is still extremely high, which would then say what is important or might impact that is what people are doing with that equity, or could we potentially lose it from home prices, which we're going to cover here in a couple slides. Now, as you look at homeowners have very high levels of tappable home equity today, providing a cushion to withstand potential price declines, but also preventing housing distress from turning into a foreclosure. The result will likely be more of a foreclosure trickle than a tsunami. So now what I want to cover is the F word, foreclosures. And so as you start looking at when people start sharing a uptick in foreclosures in the headlines, it's taking out of context what this really means. And we are expecting very few distressed properties, and show you right after this headline. Household debt soars at fastest pace in 15 years as credit card use surges. What this really means is overall, are we going to start seeing a lot of people in trouble financially? Well, guess what? They failed to mention at the end of that, but nearing levels of 2019. And remember, our tappable equity is greater than where we were in 2019, and we're still at the same credit card balance. It's just, you're right. Over the last couple of years, I believe many people received money printed by somebody and given to us in a way to spend, to keep the economy spending money and not having to put it on your credit card. But I don't know about you. I also know that in November and December, my credit card tends to be a lot higher than it normally is throughout the year. So when we take in context a report from November, you're right. There's going to be a lot of things that in this correction lead to headlines that hurt versus help you better make a decision for you and your family. And as we close with the foreclosures or the distressed properties, you can see though delinquency rates are rising, because they remain low by historical standards and suggest consumers are managing their finances through the period of increasing prices, meaning that many of us are having to work through challenges. But as you can see, the mortgage debt to income ratio near historic lows. Again, if I look at the overall household debt service ratio for mortgages as a percentage of the disposable personal income, it's still extremely low compared to where it's been since 1980, especially as you look at where it was during the housing bubble. So we'll close out with, for the second quarter in a row, the mortgage delinquency rate fell to its lowest level since the Mortgage Banker Association survey began in 1979, declining to 3.45%. Foreclosure starts and loans in the process of foreclosure also dropped in third quarter to levels further below their historical averages. Now, this is because you're reading this from that of people and experts that work for organizations to provide this data versus companies, journalists that are trying to get viewers to read through a certain headline. And like I said here, foreclosures are up. But, and we all know that nothing matters until after the but, near record lows. So as you can see, 88,000 in quarter one, quarter three, which, yes, is extremely high compared to where we were last year. But when you look at last year foreclosures in 2020, we also had a lot of policymakers implement certain things. And as you can see, where we are now compared to 07, 08, 09, 10, 11, and 12, that little 5-6 year period, if foreclosures is what we're waiting for, we may be waiting a very, very long time. So as we now know that mortgage rates were really defined through 2022, what happened as results to it because of inflation, we can then say, well, what do we expect them to be? And overall, what is the housing market forecast? And so we'll cover that. And as you look at what Jerome Powell, chair of the Fed Reserve, said, is that I'd say if you are a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset. This was back in June. So again, yes, we started to see affordability in housing become very, very difficult with what it took for those to actually accomplish purchasing a property. We need to get back to a place where supply and demand are back together and where inflation is down low again and mortgage rates are low again. So that is their goal. The challenge is inflation is still high and we're actually starting to see inventory decline again, which means that if they did still decide to bring mortgage rates down very low, you're going to see a huge amount of demand without the appropriate amount of supply. And as you can see from just that of what happened since this year, or last 50 years, we have never seen a rise in interest rates in a singular year like we saw, taking it that 6.5%. And in November, you can look at the average of all four major economist predictions around what do they believe mortgage rates will be in the first, second, third, and fourth quarter of next year. You can see that they believe they're stabilizing. We went from low threes all the way up to sevens and eights. And now this year we're saying, hey, probably just going to be around that 6.5 to 6 all year. Best case scenario with Barry Habib is 5 to 5.5%, but in some markets that will bring out a lot of demand where there's just not enough inventory. So when you look at mortgage rates could pull back meaningfully next year if inflation pressures ease. That's really what Barry was saying. So again, continue to follow what's happening with inflation, the 10-year treasury, and overall, we're most likely approaching a time period where rates still may go up a little bit over the next couple months, but when they go back down is the question, not if. The real challenge is for those in the industry. And what I mean by that is the total home sales from 1999 to October of 2022, you can see if you take that of what happened in the 2000s and you take that of what has happened over the last couple of years, we saw a lot of people transact. Even when you look at 2007, 8, and 9, look at the amount of people, meaning everybody, doing this thing called real estate. And you saw that in 2021, 2019 is a flood of people doing what everybody else was doing. If you follow Warren Buffett, he would say don't buy when everybody is, buy when other people aren't. And most likely what's going to happen next year is that we're going to see roughly about 5.1 total home sales, which is lower than that of what we've seen in the last 10 years. So the real people hurting, it means of this experience being very new to them, is that of real estate professionals and mortgage lenders. Now, as you start looking at what do you need in the future to make decisions through all this, because many people would say, hey, from an affordability perspective, I still don't quite know, is it good time to buy or sell? Is you want to find a local market expert who has this type of knowledge and can advise you through your interest in what you want to do. And by spending time learning about the market, you'll find out that you probably timed it well, meaning that you made the right decision. Versus for most people that I talk to, it's not that they're trying to time it perfectly. They just don't want to make a wrong decision. And for a lot of buyers, right now over the next 6 months could be a very good time to purchase a property before you start to see more demand come out and maybe not as many opportunities for those that are not in the position to be able to compete. Now, remember, every market will be a little different. And Lawrence Young, as he said, the upcoming months should see a return of buyers as mortgage rates appear to have already peaked and have been coming down since mid-November. So again, you're right. More buyers come in the market. If there's not as many right now, this might be a great time for me. For sellers, this is also one of those periods to decide what is it that's best for me. Should I sell and buy now, or do I sell and wait when there's more buyers out in the market? Those are both going to be based off of the national economy and your local real estate market. So every market right now is seeing differences. And as we're about to cover what's happening with appreciation, you can see the home forecast for 2023 is nationally, the predictions from all 7 experts is that we are just going to see home values remain the same. There is nobody taking into account for major loss, meaning 10 to 20%, except for Patrick Bet-David. However, most experts are saying right now, we're probably just going to see home values remain the same through 2023. But you guys know many people's predictions for 2024 and 2025, home price appreciation rising again, and really doing that most likely over the next 10 to 12 years as we just enter another normal 7 to 9 to 11 year real estate life cycle. So Mark Fleming says the housing market, once adjusted to the new normal of higher mortgage rates, will benefit from continued strong demographic-driven demand relative to an overall long-run shortage of supply. What this really is, we still have a long-run shortage of supply. Hopefully some of this slowdown is making a little bit more available. But as you start looking all across the nation and in local markets, the months of inventory is what you want to be following. And under 4 months of inventory is still a seller's market, which is what many markets are experiencing. We just have to get through some normal seasonality, which it's usually not a very good time to list a property right over the end of December and January. It's the fewest amount of listings on market and the least amount of buyers out there. However, the ones that are out there are quite serious. So it's not a matter of when is the best time to sell. What it is when is the best time to sell for you based off the decision that is right for you and your family based off your goals. Now, the nice part with this is that as you start looking at what that demographic perspective is, Doug Duncan shared from our perspective, the good news is that the demographics remain favorable for housing. So the sector appears well positioned to help lead the economy out of what we expect will be a brief recession. We hope that nobody endures suffering or pain through the recession, but most likely we're going to experience a brief recession, which will impact some people. What leads us out of recession, which has the last 5 out of 7, is housing, meaning mortgage rates will decrease, home price appreciation, and the real estate industry leads us out of the recession. And as we start looking at what the difference is for many of these demographics is that we have people that are looking to downsize. We have people that are looking to sell off their properties. We have new investors. We have that of new homeowners. And we have that of people that are reaching peak purchase power that are ready now to see a bigger home, experience diapers, divorce, many other aspects. So remember, favorable for housing is due to that of the indicators and the numbers that we're looking at versus just being optimistic about it when the numbers are bad. So we'll continue to keep the numbers up to date month over month for you. And guess what? Starting next year, because this is something we want to be following more frequently, so that way you can get ahead of timing this through spending time learning about it, we're going to provide a weekly update. Couple minutes shorter, like 5 minutes each versus 20 minutes. But we hope that the monthly market updates have helped you through this period of concern and avoiding the headlines that do more to hurt versus, hey, Justin, thank you for helping. We want to thank you for helping us over the last decade, our family, keeping us safe, keeping us warm, keeping us happy. And we wish the same for you and your family over the holidays. If we can ever help or in any way you approach next year with some real estate needs, reach out. We'll set up a 15-minute consultation. And again, if you're outside the nation, I'll get you in contact with the top 1% of agents and teams all across the world. And from me to you, happy holidays, and let's go have an amazing new year.